Hello there, this is James and you're watching Tixee Live, and a very good afternoon to all of you, and all of you a very happy Friday. In today's program, I want to discuss the violent decline of the sterling against the US dollar and ask the question, how potentially low could the sterling go? Plus, another scary story which is now spooking the market. And I want to ask another question, is this simply just the beginning? But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. So I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out the way, let's get started. So yes, today has not been a very good day for the cable. Those who are new to trading the cable, is the British pound US dollar. It's the nickname for the British pound US dollar. In fact, the British pound US dollar is trading at levels not seen since 1985. I mentioned this briefly in the watch along for the EU CPI today, but I thought I'd go into a little bit more detail on this and we can have an open discussion about it. But yes, not trading since level since 1985, and that's when Margaret Thatcher was Prime Minister. So it's a very, it's without a doubt one of the most shocking developments for a currency at the moment. And what spurred this on, it's been under pressure against the greenback for a long time anyway. But what tipped it over the edge today, and it actually hit the 113, it's currently trading now just around the 113.99 level. But what tipped it over the edge was the real negative UK retail sales, which came in negative 1.6% versus negative 0.5% expected. So they were expecting a bad reading, but not this bad. Not this bad. If you compare it to the US retail sales yesterday, which came in as a positive 0.5% increase, you can tell that the UK is really under a lot of pressure, because like I say, that's a very negative reading. And don't forget, the market or the economy needs us to go and spend our money to keep things ticking over. If we're not spending our money, then it's never a good sign for the economy. The other worrying thing is that Monday, there is a bank holiday in the UK. Monday the 19th. This is obviously for the Queen's funeral. Now, what worries the market about this is that this potentially could tip the UK into a recession sooner than later. Don't forget, the Bank of England has already predicted that the UK will fall into recession by Q4. This bank holiday, they fear, could tip it into recession closer. And the reason why they think that was back in July, there was a extended weekend again, a bank holiday weekend again in July, this time for the Queen, for more a happy occasion than Monday, for the Queen's Jubilee. And the reading after that came out negative GDP reading because of those bank holidays. So that is a worrying factor. And the other thing is, there is an awful lot of very negative UK data at the moment. Okay, UK unemployment is reasonable at 3.6%. But like I said in my earlier video, UK claimant count came up as a plus 6,500. UK manufacturing PMI was released 49.6%. Don't forget, anything under 50, any PMI reading under 50 is negative. 50 is no change. 50 plus is positive. Anything under 50 is negative. UK GDP came in 0.2%, which was a lot less than expected because they expected 0.5%. And of course, inflation, the big problem in the UK, though slightly lower, is still at 9.9%. 9.9%. Okay, yes, they expected 10.2, but still at 9.9%. And here's the worrying thing. Of course, we've got the Bank of England next week is making their interest rate decision. They were supposed to do it this week, but because of the circumstances in the UK, it's been pushed back a week. So it's next week. And obviously with inflation, it's still very record high at 9.9 and clear evidence of a slowdown in the economy. What can they do? They need to raise interest rates to tackle inflation, but how much damage is that going to do to already struggling UK economy. What is also not helping the sterling as well is the fact that dollar at the moment is king. Dollar is dominating because obviously the Fed has been extremely aggressive. They've got a lot more tools in their toolkit than the Bank of England has. They can do a lot more than the Bank of England because their economy, though is showing signs of slowing down, is still pretty robust compared to the UK. They can raise interest rates. And yes, we are expecting an interest rate hike from them next week, which is making dollar king. But again, you've got that little worry as well, recession worries. But of course, dollar is a safe haven. And there is so much worry and signs for the UK that even Jane Foley, and I've spoken about this young lady before, who's a very good FX analyst for Rabobank. She predicts the cable, the British pound US dollar, could fall all the way down to 1.10. But anyway, let's have a quick look at the sterling at the moment and the euro sterling as well. As you can see, like I say, if we put it on a daily, we can see how dramatic. We're under a major downward trend, as we can see at the moment, a major downward trend. For us to break the trend realistically, we need the sterling to get above 1.1520 and penetrate and break that, properly as well. But it's on a huge dramatic decline. And if you look at it in 30 minutes, like I say, this is, we're trading around levels not seen since 1985. And with all those facts and a strong greenback, what can benefit is maybe a technical correction, some bit of dip buying, and if we start seeing a weaker dollar, that could benefit it as well. But at the moment, all the data is not looking good for the sterling, and like I say, it is currently, as it stands, really on a downward spiral. We might see some dip buying for it, but like I say, it is clearly on a downward trend. And with that data, like I say, it is spooking the market or spooking the cable bulls. Same with again with the euro sterling. We see the euro, even though EU has its own problems, energy crisis, high inflation as well, 9.1%. A central bank who's been a bit slow to get off the mark. But even say the euro is not, the eurozone is not. Chances are, the probability of the eurozone falling into recession for the UK is very unlikely. The UK is expected to fall there first, without a doubt. So as you can see, currently trading at 0.8754 against the sterling. And as you can see, like I say, that's highest levels. If we can have a look, where are we? That's the highest levels since practically February 2021. So yeah, there we go. That's the problem with the sterling. Right, there is something else. Again, I seem to be at the moment, which is sort of frustrating me a little bit. And I was thinking about this before I came online, before I came on here. A lot of my videos over the last couple of weeks have been pretty bearish. They've all been quite doom and gloom, so to speak. And I was thinking about, very rarely do I talk anything positive. I am a very positive person. But anyway, there's some more things that spooked the market today, which is just as scary. FedEx, for example, stock price has crashed by about 20%. 20%. And that was really due to the fact that there is a brutal profit warning coming from them. A huge drop-off on their quarterly profits, and the fact that their actual overall outlook for the economy is extremely gloomy, and they have really have spooked the market. It's got a knock-on effect. But let's have a quick look now at FedEx, where it is, and you see it's opened with a real dramatic gap. Okay, a real dramatic gap. If you look at it in a bit of short term, it was trading before this announcement on the close. Okay, $202.60. It opened $156.60 after this announcement. So it's extremely spooked. And like I said, this is spooking the market, which leads me to something else I want to talk about, which is actually a question. Don't forget, I always say, if you can ask me questions anytime I'm live, anytime, it's all here or interact, say hello. But if you think of a question later, you can always put it on the comment section, either YouTube and Facebook, and I will obviously see them, and I will obviously then reply to them next time I'm live on air. And this gentleman did indeed leave a question on YouTube, and I can't answer it exactly how you would like me to, obviously, but I can talk a little bit more about it. Okay. And his question, this was by George Dillon. He left it on this morning's video. He said, I know you said we are not to take it as financial information, but how good is the US 500, S&P 500 for investment right now? Now, brilliant question. Thank you so much, Mr. Dillon, for leaving that question for me and asking me. And like I say, I will always answer the questions next time live on my air when I see the comments. Unfortunately, I can't give you, for obvious reasons, direct answer to whether or not it's a good investment, because that would be investment advice. And I can't do that. This is not, don't give trading advice. This is for information to help you with your own decision-making process. But what I can tell you, let's talk about it. Let's talk about it. Now, the S&P 500, obviously, I'll pull it up now, actually, as well. Let's pull it up because this has been affected, by several reasons, okay? It was initially affected by, obviously, the FedEx warning, okay? Because like I say, this is one company. Is this the beginning of many more companies to say the same, okay? Start saying the same. We're going to get more reactions like this. And as you can see, it's been under humongous pressure, especially since, okay, we had that higher than expected CPI reading, okay? But there's other things. We'll come back and look at it again in a minute as well. But there's other things. S&P earnings growth, the growth from all the companies in the S&P, the 500 companies. The growth is only expected to increase by 3.7%. Original forecast, this is for quarter three. The original forecast was 9.8%, which is not a good sign. The other thing is, of course, is analysts are now expecting 7 out of the 11 sectors in the index, in the S&P 500, are expected to show outright year-over-year declines in earnings in quarter three. So though the earnings season was reasonable, we just had, and as I did a video a couple of weeks back as well about Michael Burry's anticipation of this. He said those earning reports were probably the last, last hurrah of the market before reality and the decline start. So 7 out of 11 sectors in the index are expected to show outright year-over-year declines in the earnings, again, which is negative, potentially negative for the S&P 500 as well. In fact, though we did in August, because of the earnings season, well, actually, sorry, in July, we did have a little bit of a rally, and I called it a bear market rally at the time. The reason what was propping up the S&P 500 wasn't all the earnings in the pot doing very well. It was actually mainly 4 companies which were propping it up, and that was Google, Amazon, Apple, and Microsoft. All had reasonable results, all big companies, and they had reasonable earnings. But what wasn't taken into account, there was a number of other companies who had so-so earnings, like a number of banks who reported worse than expected earnings. So, and don't forget, JP Morgan, Goldman Sachs are predicting the decline in growth. All of this can indeed affect the S&P 500. So there we had a bear market rally back in July on the earnings. The next earnings is expecting to be worse. Like I said, again, 7 out of the 11 sectors in the index are expected to show outright year-over-year declines in earnings. The only exception, I think, is the energy sector for obvious reasons. And again, don't forget, yesterday, I think it was yesterday, I spoke about Michael Wilson, who was one of the chief analysts of Morgan Stanley, a well-known outright bear in the market. And he says, and I quoted him yesterday, I'll do the same quote now. He says, acknowledgement of the poor performance of equities year to date, we do not think the bear market is over or our earning forecasts are correct, if our earning forecasts are correct. So basically, if they are correct about earnings, then yes, there's potentially more sorrow to come. Like I also mentioned yesterday, their expectation by the year end out is for the S&P to fall to 3,400 points. If recession hits this year, which looks unlikely for the US, probably in the beginning of quarter three, they reckon 3,000 points. So it is still got a very negative tone to it. You can obviously expect some dip buying in the short term, but in the medium to long term, obviously the market general conception for it and for the market in general is fairly negative. Changing of this, we could get surprise earnings, and we could potentially get a surprise with the Fed next week, which could change everything, of course. I don't think they would surprise us by only doing 50 basic points or 25 or even hinting at a pivot. But anyway, okay, let's have a look at it now. Like I say, the key level for me, the next key level or potential support or area I'm watching on the S&P is 3,808 points. That's on Fibonacci of 38.2. Key level for me, though, for it to gain any real bullish momentum to cleanly break it through will be 4,099 points, followed by another key area of interest I've been watching, Fibonacci level 23.6, which is 4,190 points. So yeah, there we go. And let's have a quick look at the other things in the market. Anyway, like I say, I hope that so again, I can't answer the question directly, but I hope that gives you enough information for you to go. What's your name again? Sorry, Mr. Dillon. I hope that gives you enough information for you to go and do your own research and have a look into it and make your own, do your own diligence and make your own decision. But I hope that gives you enough to, for you to find a way to carry on with your research on that. Let's have a quick look at other things in the market as well. Like I say, the euro, again, still pretty much no change today. Very little activity. It's all been about the sterling and the cable. Even though the EU CPI came in as expected, still very little change. Still trading in that key area of interest for me, 1.0057. Gold, okay, managed to find a bit of a bounce, a bit of support after that level I've been watching, of course, $1,667.86. But still, we have pretty much dollar strength. The only thing that the dollar is struggling against at the moment is the yen. Currently trading at 143.08. Again, there is anticipation, maybe, just maybe, the Bank of Japan will finally intervene on this. And the first time they've intervened since 1998. But anyway, what a week, though. What a week this week has been. We started off with a bit of a bounce, the euro recovering slightly, having a good bounce. We did a video again. We talked about it. S&P, we had 4 days of gains as well. Everything was looking good, but we did say that potential data on Tuesday coming out could change everything, which was US CPI. Guess what? It did. It did change everything. It came out higher than expected, 8.3% versus 8.1% expected. Core came in at 66.3% versus 6.1% expected. Knock-on effect, market sold off. Massive crash in the market. The worst day for stocks since 2020. And then since then, we've had a lot of doom and gloom. Obviously, we've had more warnings from Morgan Stanley. And of course, we've had obviously very famous billionaire investor also warning that the market could fall by 20% if interest rates went to 4.5%. So pretty gloomy throughout the remainder of the week. But what a week. It's been an exciting week. That Tuesday result, that CPI on Tuesday was dramatic, was a real game changer. But I say, let's see, that's this week. But next week, we got an even bigger week. We got US building permits, US housing starts, Canadian CPI, 2 big ones, US interest rate decision on the Wednesday, and UK interest rate decision, Bank of England interest rate decision. Both of those potentially could be massive. And wrapping up the week, we have EU manufacturing services PMI. So what a week to have indeed. I will be doing a special on the US interest rate decision, and I will be doing a watch along on the UK interest rate decision, because like I said, I really think the Bank of England are in a rock and a hard place at the moment, especially with the state of the sterling. The market as it currently stands, FTSE slightly negative 0.07. DAX also in the red, negative 1.76%. US stock 50 currently trading negative 0.81%. Don't forget, you can ask me questions anytime you wish, or simply say hello if you like. Well, let me know what you think. Let me know your opinions on the matter. Let me know what you think about it. Not to worry. If you think of a question later, like Mr. Dillon did, please put it in the comments section below. Okay, I will see it, and I will reply to it next time I go live on air, which will be Monday. I'm going to do one broadcast Monday, but I'll be back in full action on Tuesday for 2 broadcasts. So I'll be back on doing my broadcast on Monday at 8 a.m. UTC. So, please come and join me for that if you can. Okay, if there is no questions, if there's questions, not to worry. Like I say, anyway, if you're watching me, as I always say, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video and you put up with me, my over-the-top, enthusiasm, which I can't help because I'm excited and I love the markets, then give me one of these. I see I've got a couple already, and I've got a love heart as well, which is really nice. But give me one of these. I really appreciate it because it's nice to know that you like what I do. So that's good. And plus, I always appreciate everybody coming to watch me. I really do. I really appreciate all you taking the time out to watch and to be with me. So I really appreciate it. Anyway, till next time, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.